The transition from December 31st to January 1st represents more than a calendar change in institutional finance. It marks a fundamental shift in market dynamics that creates predictable capital flows worth hundreds of billions of dollars. Today, we're examining the economic mechanics behind what market participants call the January effect and analyzing how these systematic flows interact with current silver market conditions to create potential price volatility that extends far beyond normal market fluctuations. Financial markets operate on multiple overlapping time cycles that create distinct behavioral patterns throughout different periods of the year. While retail investors make decisions based on news events, emotional reactions, personal financial situations, and social media influences, institutional investors operate according to predetermined schedules tied to fiscal reporting periods, regulatory compliance deadlines, fiduciary responsibilities, and mathematical portfolio optimization requirements. Understanding these institutional cycles provides crucial insight into market timing patterns, capital allocation decisions, and the predictable flow of investment capital that moves markets regardless of fundamental economic conditions. December 31st represents the fiscal year end for most major institutional investors, including public and private pension funds, university endowments, insurance companies, hedge funds, mutual fund complexes, and family offices managing substantial assets. This date creates what economists call a regulatory snapshot effect, where institutions optimize their portfolios primarily for reporting purposes, regulatory compliance, and performance measurement rather than pure investment performance optimization. The regulatory and reporting pressures during December create systematic market distortions that experienced investors can anticipate and potentially profit from. The December pressure focuses intensely on defensive positioning strategies that prioritize risk reduction over return maximization. Portfolio managers systematically lock in gains by selling winning positions, particularly important for compensation structures tied to calendar year performance metrics and bonus calculations. Risk management departments pressure traders to reduce exposure to volatile assets that could generate losses during the final trading days of the year. Banks reduce commodity positions and equity exposure to lower their global systemically important bank surcharge calculations, which are based on year-end balance sheet snapshots and affect their regulatory capital requirements. Individual taxpayers add another layer of systematic selling pressure by harvesting tax losses to optimize their after-tax investment returns. This tax loss selling creates additional downward pressure on underperforming assets as investors realize losses for tax purposes while maintaining their desired asset allocation through similar but not identical replacement purchases. The combination of institutional risk reduction, performance preservation, and tax loss selling creates predictable downward pressure on many asset classes during December. The moment the calendar transitions to January 1st, these defensive pressures reverse completely and immediately. Tax considerations reset to a new tax year, providing a fresh start for tax planning strategies. Regulatory snapshots are complete, allowing risk management departments to focus on profitable opportunities rather than compliance optimization. New performance measurement periods begin, giving portfolio managers clean slates for generating returns and taking calculated risks that were discouraged during year-end reporting periods. This dramatic shift creates systematic buying pressure that has nothing to do with fundamental economic analysis, company-specific news, or global market developments, and everything to do with mathematical portfolio rebalancing requirements and institutional mandate compliance. The predictable nature of these flows creates opportunities for market participants who understand the timing and scale of institutional rebalancing activities. The January effect manifests most powerfully during the first 5 trading days of the new year, when institutions execute their annual portfolio, rebalancing trades according to predetermined schedules and allocation targets. Modern portfolio theory, which forms the foundation of institutional investment management, requires diversification across multiple asset classes according to predetermined target allocations that are designed to optimize risk-adjusted returns over long time periods. These allocation targets are typically established by investment committees, approved by trustees or boards of directors, and implemented systematically regardless of short-term market conditions. A typical institutional portfolio might target specific percentages across various asset categories: 60% equities, 30% fixed income, 5% real estate, 3% commodities, and 2% alternative investments. During periods of market volatility and varying asset class performance, these allocations drift away from their targets as different investments perform differently. Portfolio mathematics requires periodic rebalancing to maintain the desired risk and return characteristics. Portfolio rebalancing involves selling overweight positions and buying underweight positions to return to target allocations, regardless of recent performance trends or market sentiment. This systematic approach often requires selling assets that have performed well and buying assets that have performed poorly, creating contrarian investment flows that can appear irrational from a momentum perspective, but serve important portfolio optimization functions. In 2025, traditional assets like government bonds and corporate credit experienced significant volatility and generally poor performance due to interest rate uncertainty, inflation concerns, and economic growth questions. Stock markets showed high volatility with uneven sector performance, creating challenging conditions for traditional 60/40 stock and bond portfolios. Meanwhile, alternative investments like precious metals, real estate, and commodities outperformed substantially, providing positive returns while traditional assets struggled. This performance divergence means most institutional portfolios ended the year significantly underweight in alternative assets and overweight in traditional assets relative to their target allocations. The mathematical consequence is clear and predictable. Institutions must sell traditional assets and buy alternatives during their January rebalancing period to return to optimal portfolio configurations. The scale of this rebalancing reflects the enormous size of institutional portfolios under professional management. Global pension funds alone manage approximately $50 trillion in assets across public employee retirement systems, corporate pension plans, and individual retirement account aggregators. University endowments add another $1 trillion in professionally managed assets. Insurance companies manage additional trillions in policyholder reserves that require diversified investment approaches. Sovereign wealth funds, family offices, and foundation endowments contribute further trillions to the institutional investment universe. Even small percentage allocation shifts represent enormous absolute dollar amounts when applied to these massive asset bases. If global institutional investors decide to increase their precious metals allocation from 1% to 2% of total portfolios, this represents approximately $500 billion of new buying demand that must be deployed in precious metals markets over a relatively short time period. Consider this demand surge relative to the size of precious metals markets. The entire annual global mine production of silver totals approximately 800 million ounces, worth $56 billion at current prices of approximately $70 per ounce. Gold annual production totals approximately 3,500 tons, worth roughly $250 billion at current prices. The entire capitalization of precious metals markets represents a tiny fraction of institutional assets under management. Institutional rebalancing flows can overwhelm the annual production of entire commodity sectors and create dramatic price movements that persist until new equilibrium levels are established. The timing concentration amplifies these effects substantially because institutions typically execute rebalancing trades during the first week of January to minimize tracking error against their benchmark allocations and satisfy fiduciary requirements for prompt rebalancing. This creates artificial demand surges that are completely unrelated to fundamental supply and demand changes, company-specific developments, or economic news. Market participants who understand these mechanical flow patterns can position accordingly, while those who ignore institutional mechanics often find themselves surprised by seemingly irrational price movements that appear to contradict fundamental analysis. Silver's performance characteristics in 2025 make it particularly attractive for institutional allocation increases during the January rebalancing period. While major bond indexes declined substantially due to interest rate volatility and credit concerns, and equity markets showed high volatility with uneven sector performance, silver appreciated significantly and demonstrated lower correlation with traditional assets during stress periods. These performance characteristics make silver attractive from both return enhancement and diversification perspectives. Portfolio optimization models that analyze historical returns, volatility patterns, and correlation relationships typically recommend increased precious metals allocations after periods when traditional assets underperform and alternative assets outperform. Academic research consistently demonstrates that modest precious metals allocations improve portfolio efficiency by reducing overall volatility while maintaining expected returns. The current silver market structure compounds the potential impact of institutional buying flows in ways that create exceptional conditions for price appreciation. Unlike highly liquid markets such as United States Treasury bonds or large-cap technology stocks, where substantial buying can be absorbed without dramatic price effects, the silver market operates with limited daily trading volume and relatively thin order books that cannot accommodate large institutional orders without significant market impact. Daily silver futures, trading on the COMEX, typically represents $50 to $100 million of notional value, depending on volatility levels and market participation. Institutional buying flows of billions of dollars cannot be absorbed at current price levels without dramatic upward price movements that continue until higher prices reduce quantity demanded or incentivize additional supply. The disconnect between paper silver futures prices and physical silver availability represents one of the most significant structural imbalances in modern commodity markets, with implications that extend far beyond precious metals trading to fundamental questions about price discovery mechanisms, market efficiency, and the relationship between financial instruments and underlying physical assets. While futures contracts trade at $71.47 per ounce on electronic platforms, physical silver dealers across multiple continents are quoting prices $15 to $25 higher, reporting extended delivery times ranging from 8 to 16 weeks, and in many cases, experiencing complete inventory depletion across popular product categories. This pricing divergence reflects fundamental changes in supply chain dynamics that extend far beyond normal market fluctuations or temporary inventory adjustments. The gap between paper and physical prices indicates structural problems in the mechanisms that typically keep financial markets aligned with underlying commodity realities. Understanding these dynamics provides crucial insight into how commodity markets function during periods of supply stress, and how financial innovation can sometimes create disconnections from physical market realities. Physical silver supply chains operate through complex networks that differ fundamentally from financial markets in ways that affect price discovery, availability, and the relationship between supply and demand. Mining companies typically sell their production through long-term contracts with refineries and primary distributors, rather than in spot markets, creating stable revenue streams, but reducing their ability to capture short-term price increases. These contracts often include volume commitments, quality specifications, and delivery schedules that cannot be easily modified to respond to changing market conditions. Refineries process raw silver from mining concentrates into standardized forms required by different end users, including industrial applications like electronics manufacturing and solar panel production, investment products such as coins and bars, and specialty applications in medical devices, aerospace components, and advanced technology systems. Each end-use category requires different purities, forms, and certifications, creating specialized supply chains that cannot easily substitute for each other during shortages. Distributors maintain regional inventory systems to serve local markets and manage the complex logistics of physical delivery, including transportation, insurance, storage, and compliance with various regulatory requirements across different jurisdictions. These distribution networks typically maintain inventory buffers, equivalent to several weeks or months of normal sales, to manage routine demand fluctuations and ensure reliable customer service during minor supply disruptions. However, current market conditions have overwhelmed these traditional buffering mechanisms across multiple levels of the supply chain simultaneously. Industrial demand for silver has increased substantially due to accelerating solar panel manufacturing growth, driven by government renewable energy mandates, electric vehicle production expansion as automotive companies transition away from internal combustion engines, and 5G infrastructure deployment requiring silver-intensive electronic components for high-frequency signal processing applications. Simultaneously, investment demand has surged as investors seek inflation hedges and alternative assets during a period when traditional asset classes have delivered poor risk-adjusted returns. The combination of industrial demand growth and investment demand increases has created unprecedented pressure on supply chains designed for more predictable demand patterns. The inventory depletion extends across multiple stages of the distribution system, creating compounding effects that amplify supply constraints. Retail dealers report selling existing inventory faster than they can secure replacement stock from regional distributors, who typically maintain relationships with multiple refineries and mints. These distributors describe increasing difficulty sourcing products from refineries and government mints that typically maintain reliable availability through established production schedules and inventory management systems. Refineries indicate that raw silver supply from mining companies has become less predictable, while demand from industrial customers has increased substantially, creating competition between industrial users and investment product manufacturers for limited refined silver supplies. This competition forces refineries to prioritize customers based on long-term relationships, contract terms, and pricing considerations, often leaving investment product manufacturers with reduced allocation access. The supply chain stress creates delivery delays that compound the shortage effects through inventory hoarding behavior and forward buying by customers who anticipate further delays. Normal silver product delivery times of 1 to 2 weeks have extended to 8 to 12 weeks for many popular products, including American Silver Eagles, Canadian Maple Leafs, and generic silver rounds that typically maintain consistent availability. Some dealers have implemented allocation systems that limit customer purchase quantities, while others have stopped taking orders for certain products entirely until they can secure reliable supply sources from upstream suppliers. Extended delivery times force customers to place orders earlier and in larger quantities than normal, creating additional demand that further strains already constrained supply systems. The premium structure reflects these supply constraints through basic economic principles that govern price formation when supply becomes limited relative to demand levels. Physical premiums represent the additional cost. Buyers must pay above futures prices to secure actual delivery of metal rather than paper contracts that may not provide access to physical silver when needed. Current premiums of $15 to $25 over futures prices suggest severe supply constraints relative to demand levels, indicating that the physical market is pricing silver based on replacement cost and scarcity value rather than futures-based pricing that may not reflect actual availability. These premium levels exceed historical norms by substantial margins, even during previous periods of elevated precious metals demand. Bank trading strategies demonstrate sophisticated understanding of these market dynamics, regulatory requirements, and the predictable patterns of institutional capital flows that create profitable trading opportunities. The global systemically important bank surcharge requires large banks to maintain specific capital ratios based on year-end balance sheet calculations that affect their regulatory status, borrowing costs, and operational flexibility. Commodity positions, particularly long positions in volatile assets like precious metals, increase banks' risk-weighted asset calculations and reduce their regulatory scores under the Basel III framework. These regulatory requirements create systematic pressure for banks to reduce commodity exposures during December, regardless of market conditions or trading opportunities, leading to predictable selling pressure that often drives prices lower. During December, banks systematically reduced commodity exposures through various trading strategies designed to optimize their year-end regulatory calculations. This selling pressure often creates attractive entry points for other market participants who understand that the selling is driven by regulatory requirements rather than fundamental market analysis. However, once the regulatory snapshot is complete on December 31st, banks can refocus on profitable trading strategies rather than compliance optimization. Professional trading desks maintain sophisticated models that track institutional flow patterns, understand the timing and scale of pension fund rebalancing activities, and monitor the asset allocation mandates of major institutional investors. This advanced knowledge allows banks to position themselves strategically ahead of predictable demand, purchasing assets before institutional buyers enter the market, and selling to them at higher prices during peak demand periods. This front-running strategy represents standard institutional trading practice rather than market manipulation, as banks provide essential liquidity services to institutional customers by maintaining inventory, managing timing differences between customer demand and market availability, and absorbing the risks associated with position holding during volatile periods. However, this positioning often creates situations where banks become substantial net buyers of assets they recently sold for regulatory optimization purposes. The transition from December selling to January buying often creates dramatic reversals in bank net positioning within very short time periods. Trading desks that spent December systematically reducing silver exposure to meet regulatory requirements will spend January accumulating silver inventory to serve anticipated institutional customer demand, creating a complete reversal in their market impact. This shift from net seller to net buyer can represent substantial trading volume, given the size of major bank trading operations and their sophisticated execution capabilities. When banks transition from selling pressure to buying pressure, they simultaneously remove a significant source of supply while adding substantial demand, creating dual effects that amplify price movements beyond what would result from institutional buying alone. Market impact analysis reveals how these bank positioning changes affect price momentum and market structure during periods of transition. The combination of reduced bank selling pressure and increased institutional buying creates conditions for rapid price appreciation that can persist until new equilibrium levels are established. Electronic trading platforms provide banks with sophisticated tools to implement these positioning strategies efficiently across multiple markets and time zones. Algorithmic trading systems enable banks to execute large orders while minimizing market impact through careful timing and order fragmentation. These systems can accumulate positions gradually during low-volume periods, take advantage of natural market movements to mask their activities, and coordinate across related markets to optimize execution efficiency. The Globex electronic session that reopens tonight offers the first opportunity for banks to implement their new positioning strategies following the regulatory year-end transition. Electronic platforms allow gradual accumulation of long positions, while Asian markets remain active and European markets prepare to open, providing timing advantages for establishing positions before North American institutional buyers enter the market on Friday morning. Physical dealers serve as an important information source for understanding real supply and demand conditions versus paper market pricing. Dealer premiums, inventory levels, and delivery times provide direct feedback about actual silver availability that may not be reflected in futures pricing. When dealers consistently report shortages and, quote, substantial premiums, it indicates genuine supply constraints that will eventually affect futures prices. The current dealer shortage reports come from multiple geographic regions and affect various product categories, suggesting systematic supply constraints rather than localized disruptions. American silver eagles, Canadian maple leafs, generic silver rounds, and industrial silver products all show similar availability problems and premium increases. This broad-based shortage pattern indicates fundamental supply and demand imbalances rather than temporary disruptions. International arbitrage opportunities emerge when regional markets show persistent pricing differences that exceed transportation and transaction costs. Currently, silver prices in Asian markets often exceed North American prices by margins greater than shipping and insurance costs. This creates profit opportunities for traders who can source silver in lower-priced markets and sell in higher-priced regions. However, these arbitrage opportunities depend on the ability to source physical metal reliably. If North American dealers cannot secure inventory for delivery to Asian customers, the apparent arbitrage opportunity cannot be executed profitably. The breakdown of normal arbitrage mechanisms indicates severe constraints in physical supply chains that may force regional markets to operate independently. The current silver market situation occurs within a broader macroeconomic environment characterized by unprecedented monetary policy challenges, structural inflation pressures, and evolving geopolitical relationships that collectively create favorable conditions for alternative asset appreciation. Understanding these macroeconomic frameworks provides essential context for evaluating silver's role in institutional portfolios and individual investment strategies. Global debt levels have reached historically unprecedented proportions that create fundamental constraints on monetary policy, effectiveness, and economic growth potential. Total global debt, including government, corporate, and household obligations, exceeds $300 trillion, representing approximately 350% of global gross domestic product. These debt levels create mathematical limitations on interest rate policy and fiscal spending capacity that affect all asset class valuations. Government debt dynamics particularly constrain central bank policy options during inflationary periods. The United States federal debt approaches $34 trillion, requiring approximately $1 trillion annually in interest payments at current rates. Each percentage point increase in average borrowing costs adds approximately $340 billion to annual interest expenses, forcing difficult choices between debt service and other government spending priorities. This debt burden creates what economists term the fiscal dominance problem, where monetary policy becomes subordinated to fiscal financing requirements. Central banks cannot raise interest rates sufficiently to combat inflation without causing government financing crises. Similarly, they cannot maintain elevated rates for extended periods without triggering sovereign debt sustainability concerns. These constraints limit traditional monetary policy tools and force reliance on alternative approaches. Quantitative easing programs represent central bank attempts to manage debt sustainability while maintaining some inflation control capacity. However, these programs create their own economic distortions by artificially suppressing interest rates, encouraging excessive risk-taking, and increasing wealth inequality. The side effects of quantitative easing often necessitate additional interventions that compound the original problems. Current inflation dynamics demonstrate the limitations of monetary policy in addressing supply-side price pressures. Traditional economic models assume that higher interest rates reduce demand enough to bring supply and demand into balance at stable price levels. However, contemporary inflation includes substantial components driven by supply chain disruptions, energy transition costs, and geopolitical conflicts that do not respond predictably to demand management policies. Energy markets exemplify these supply-side inflation pressures. The transition from fossil fuels to renewable energy sources requires massive infrastructure investments and creates temporary capacity constraints during the transition period. Geopolitical conflicts affect energy production and transportation in ways that monetary policy cannot address directly. Climate change impacts agricultural production and supply chain reliability through weather disruptions and long-term environmental shifts. Labor market dynamics contribute additional structural inflation pressures that resist traditional monetary policy solutions. Demographic changes in developed countries create worker shortages in key sectors regardless of economic growth rates. Globalization reversals due to trade conflicts and supply chain security concerns increase labor costs by reducing access to low-cost international workers. Technological automation affects different sectors unevenly, creating skill mismatches that persist despite overall employment levels. These structural inflation factors suggest that central banks face a choice between accepting higher inflation rates or triggering severe economic recessions through aggressive interest rate increases. Given the debt sustainability constraints discussed above, most central banks will likely choose to accept moderate inflation rather than risk financial system stability. This choice creates favorable conditions for inflation hedge assets like precious metals. Silver's unique position as both an industrial commodity and a monetary asset provides multiple sources of demand support during inflationary periods. Industrial demand continues to grow due to technological applications that require silver as unique properties regardless of price levels. Solar panel manufacturing, electric vehicle production, and electronic device manufacturing cannot easily substitute alternative materials for silver's electrical and thermal characteristics. Simultaneously, silver serves as a store of value during currency debasement periods when traditional savings vehicles lose purchasing power. Unlike bonds or bank deposits that provide fixed nominal returns, precious metals maintain purchasing power over long time periods by appreciating in nominal terms during inflationary periods. This dual industrial and monetary demand creates more robust support than assets serving only one function. International monetary system evolution adds another dimension to precious metals demand. The dominance of the United States dollar as the global reserve currency faces challenges from alternative payment systems, regional trading blocs, and digital currency developments. Central banks worldwide have increased gold purchases substantially as they diversify reserves away from dollar-denominated assets. Silver often participates in these diversification flows as a lower-cost precious metal alternative. Investment strategy considerations require understanding both the potential opportunities and risks associated with alternative asset allocations during periods of monetary and economic transition. While precious metals offer inflation protection and portfolio diversification benefits, they also involve volatility, storage costs, and opportunity costs relative to income-producing assets. Portfolio allocation methodology suggests treating precious metals as insurance rather than speculation. Insurance costs money but provides protection against specific risks that could severely damage other portfolio components. A 5 to 10% allocation to precious metals provides meaningful protection against currency debasement and inflation without overwhelming exposure to commodity volatility. The gold to silver ratio provides a useful framework for managing precious metals allocations over time. Historically, this ratio fluctuates between 15 to 1 and 80 to 1 over complete economic cycles. Current levels around 60 to 1 suggest silver remains relatively undervalued compared to gold. As monetary conditions become more supportive for precious metals generally, silver often outperforms gold, causing the ratio to compress toward historical lows. Risk management requires understanding the behavioral psychology that affects investment decision-making during periods of rapid asset appreciation. Market manias create emotional responses that often lead to poor timing decisions, excessive leverage use, and inadequate diversification. Successful investment strategies include predetermined exit criteria, position sizing limits, and regular rebalancing disciplines that prevent emotional decision-making. The current environment combines multiple supportive factors for silver appreciation. Institutional portfolio rebalancing needs, physical supply constraints, bank positioning shifts, and favorable macroeconomic conditions. However, these factors create potential for both opportunity and risk depending on implementation strategy and risk management discipline. Market participants should focus on understanding the underlying economic forces rather than attempting to predict specific price movements or timing. The macroeconomic trends supporting alternative assets will likely persist for years rather than months, suggesting that precise timing matters less than consistent exposure and disciplined risk management.